Hey, it's Les with the Les Walden Real Estate Team, and I am here with Shane Miller, founder and CEO of Newtory Lending. Just a little bit about him. First of all, Newtory Lending is the preferred lender of Les Walden Real Estate. And let me tell you why. It's not because Shane and I are great friends. It is because Newtory Lending always works their tail off to find the best rates, the best loan program for any clients that we ever send over to them. And we really appreciate that. And in addition to doing all that, he's just an all-around good guy. So Shane, thanks for being here. Yeah, I knew I'd get him to laugh with that, but he is really an all-around good guy. So what I've done, guys, is I've brought in an expert. I don't know about you, but I've heard on the media just repeatedly, Shane, that the Fed, Jerome Powell, Mr. Powell, might be the most famous name in America, is gonna drop interest rates, right? And everybody's like, oh, wow. So I'm getting bombarded with questions about mortgage rates because people are equating interest rates, Fed, to mortgage rates and all that stuff. So I've got a couple questions for you to hopefully allow us to clear that up.
Sure.
Mr. Powell indicated, didn't say he would, right? That at least they're thinking about potentially dropping an interest rate, the Fed rate, at their September meeting. So how would that, if they do that, how would that impact mortgage rates?
Les, that's a great question. And first of all, thank you for your kind words. You know, we feel the same way about you and your team. So the trigger word right now in the media, of course, is paved. He's paved the way, right? So the Fed has paved the way to a potential rate cut, a funds rate cut in the month of September. While one could argue there's not a direct correlation between the Fed funds rate and mortgage rates. Right now, we obviously are seeing that whatever the Fed does has more of an impact than it has in times past. Now, what most banks do is they generally, leading up to any type of cut, based on speculation and what they believe the market's going to do, most of the time, those rates are already beginning to bake in. Okay. So if the expectation is for the Fed to cut, and if the market responds positively to that, and it should, then most of the time, banks leading up to that date has already changed their rates in anticipation.
Let me kind of think through that with you for a guy that's in the business here. So you're telling me if the Fed is going to meet in September, and Mr. Powell has paved the road for this cut, the banks are thinking, okay, he is going to do this. And if he does it, we want to kind of get ahead of him, and we're going to go ahead and maybe adjust our rates a little bit. And so by the time he says, oh, we're going to cut rates by a quarter, the bank may have already adjusted slightly to account for that.
That's generally speaking. Yeah, now obviously not every organization does it the same way, but most of the time you're going to see an anticipation of that. Banks are already baking that in a little bit. Okay. The closer you get to that date, the higher that probability that it's going to happen, because the market's betting on it, then the banks have already expected it. They've adjusted for that.
A little bit.
Right.
Okay.
Now the opposite is true. If it doesn't happen and it's supposed to happen, that's where things start getting a little chaotic.
So I'm glad you brought that up. So he's paved the way. So everybody's believing, or at least wanting to believe, he's going to adjust the Fed rate. He does a juke move, right? And doesn't do it.
Right.
Then you're saying what may have happened is a bank may have lowered it slightly leading into that, right? May have lowered it. And then because he did this move and didn't do it, it might even go back up just a hair.
Sure.
Okay.
Sure. Yeah, absolutely.
There's a chance for that.
If it's expected to happen and then for whatever reason it doesn't happen, right now the probability is quite high.
Right.
But if it doesn't happen, that's when things will start to get a little interesting.
Yeah. Hence why the media is all over it at this point. Right.
Right.
So another question for you is, let's assume, well, no, I'm going to take a step back because I've always heard that mortgage rates are really not tied to the Fed rate. They're tied to some other interesting tools in the market. So tell me, I mean, we're talking about adjusting slightly because Mr. Powell was talking about But what are mortgage rates? If I'm going to go buy a home, what is my mortgage rate truly tied to? What makes that work?
Well, there's the historical answer and there's the today answer, right? I mean, traditionally, there's a lot of economic factors, both those that are close to home and geo-economically. But treasuries obviously have an impact generally on mortgage interest rates. But when I say there's not a direct correlation, because the Fed has so much influence and power right now, we're obviously seeing that the Fed is influencing rates a lot more than they have in the past from a mortgage perspective.
Right.
Obviously, they set the funds rate, right? So that's their job, and that's what they do to set monetary policy. But today, because there is so much emphasis on mortgage rates and the housing economy in general, that what the Fed does is having more of an impact today.
Right. Okay, well, that makes sense too. And of course, the media helps with that, right?
Sure.
Plastered everywhere. So I'm gonna put you in a scenario and just get your opinion. And I'm qualifying it for you. It's your opinion because I'm sure if you had control of the rates, you'd make them super low, wouldn't you? You'd make like 3%. Everybody'd be wanting to buy stuff. But Shane does not have control of the rates. So this is your opinion. Let's just assume that the Fed does cut the interest rate, the Fed rate. What do you think that impacts? So let's say they cut it 1/4%. What is that impact, do you think that impact might be on a mortgage rate?
So if they cut 25 basis points, right now I can give you a couple of answers. There's a ton of surveys out there, obviously, and it depends on which one you follow and which one you believe in the most. But if the Fed cuts 25 basis points, and I think that's the general expectation right now, I think what you're already seeing, Les, is the speculative part of that, the forecast part of that is already occurring. So right now, most of the surveys that I'm watching on a national level have rates today between about 6.52 and 6.58 on average today. And I don't know that that's going to significantly change if the Fed cuts by 25 bips because we're already expecting that to happen. Now, what will happen leading up to that is I do think that unless something significant happens in the market between now and then, I do think that rates will continue coming down at a moderate pace, very slowly leading up to that.
Okay.
So I could see us on average being in the high 6.4s leading up to that date if nothing happens significant. And to go a step further, if I will, I do think it's interesting, and this is something to note. I'm an optimistic guy, so I'm going to give you my opinion, and it may be 100% wrong, all right, because it's an opinion. But Fannie Mae recently revised their end-of-year rate to 6.5%, okay? Which was kind of surprising to me because every indicator that we have today suggests that rates may continue coming down moderately. So when they bumped it up to 6.5, that was kind of surprising. So it's going to be interesting to see what happens, but my gut, if I'm an optimistic guy, I would tell you that I think by the end of 2026, I don't think it's out of the ordinary for us to expect a 6 1/4, 6 3/8 interest rate on average.
And that's, of course, anything where it comes down is beneficial. So for the person sitting on the fence that's been out there thinking they want to move, thinking they want to buy a new home, whether it's a move up, whether it's a right size or scale down, or maybe first time home, whatever it might be, what would your advice be today for that person?
My advice is almost always the same, Les, when it comes to buying. The answer is now. And the answer is now. I'm going to probably get some flack for that. There's plenty of other opinions out there that may tell you to hold, rates are going to come down, this is going to happen, that's going to happen. But ultimately, real estate is normally a fairly safe bet in our country. And because of that, as rates continue to come down, the more they come down, I think the more buyers you're going to see get back in the buying pool. And as that happens, we're going to see all the things that come with that. Appreciation, more multiple offers, harder for folks to buy the home they could have bought today with with very little competition. So my answer is always now.
Yeah, and we've run into that some in the real estate industry where people are like, well, I'm waiting on this. I'm waiting on interest rates to come down. This is one I love. I'm waiting on interest rates to come down. And then my question is, well, what rate are we looking for? And 9 times out of 10, they can't tell me a rate. So They don't really know why they're waiting. So, guys, bottom line is this. If you're thinking about buying, your first step is to get pre-approved. Call Newtory Lending, go through us, we'll put you in touch with these guys. Get pre-approved. The reason you want to do that is multiple. First one is you know exactly what your payment's going to be, right? You got an idea. You know how much money you got to bring to the closing table. How do you structure an offer if you don't know those things? The second thing it does is when you do find the right property and you want to make an offer on that property, it shows the seller that you're serious. You've taken a step already to get yourself ready to close on that property. And every seller wants you to close on the property. So that puts the seller in a better frame of mind. I'm also going to tell you this. If you get pre-approved and you can afford to buy. I'm like Shane. I have helped and seen and personally myself made lots of money on owning real estate. And I'm telling you just from a personal home perspective. I believe the number's in the 40 some odd percent. Net wealth of someone that owns their own home versus rents is their net wealth is 42, 43 some odd percent higher than the person that just pays a rent. And I'll say it this way if it makes more sense to you. If you're renting, you are paying a mortgage. You're just paying someone else's at 100% interest. Would you rather pay 100% interest or would you rather pay maybe 6.5% interest? Me personally, I'm going for the 6.5. So guys, I hope this helped you understand a little bit more about where interest rates may or may not go, why this media coverage of the Fed is not necessarily reflective of where mortgage rates are going to go. And I personally want to thank Shane Miller for coming over. Anytime I have a question about what's going on in the mortgage market, this is the guy I reach out to. So reach out to Newtory Lending if you have that question. And then if you want to buy, reach out to us here at Walden Real Estate.